Welcome back to Beyond the Stock Market, a Groundfloor production. We're back for part 2 of our conversation with Jillian Murrish, CEO and co-founder of Pier Asset Management. Jillian, thanks again for joining us. In the last segment, we explored specialty finance as a whole and introduced music royalties as one of the unique areas where Pier invests. You guys are in a lot of different areas, but that one is one of the newer ones that we're talking about here. I'd love to dig deeper into where you see the market and specialty finance heading in this part of our conversation. So let's take a step back. Where do you think we are in the broader market cycle right now, and what signals are you watching most closely?
I don't pretend to be a macroeconomist, and fortunately, I don't actually have to in investing in music royalty. What I do know is things are volatile, things are uncertain. We could argue directionally where things are heading. Either way, I could probably make a great case for the near to the long term. And the beauty about music royalties is that it's non-correlated. Changes in the stock market don't affect the value of royalties. Increases in unemployment don't either. Interestingly, during the last downturn, music actually performed better. And so some folks out there beating the drum that, hey, music is actually inversely correlated. It actually can do better during a hard time. Folks aren't going out and spending money on going to the movies, but they're spending more on their streaming subscriptions, which is supporting these royalty payments. And so ultimately, I look at it and I say, this is a great place to be spending time in during times of uncertainty. I don't go as far as to say it's inversely correlated, but, I certainly know that increases in unemployment, don't seem to be so tightly correlated to this. And that's nice with all the uncertainty.
Well, yeah. And if you think about some of the concerns that private credit investors would have right now about AI sort of disrupting software company revenues, for example, in private credit. We've talked about that on this show in previous episodes. If you think about even in real estate, where Groundfloor has been very active, and sort of what's happening with interest rates and what is that going to mean for house prices? Fortunately, we're in the debt part of the capital stack, not the equity part of the capital stack, which is a good place to be in a time like that. But I think as people look across public markets, and then, they certainly see risk, they certainly see a lot of volatility, but then even in some private markets, people are. So it's kind of interesting to think about these specialty finance categories that don't have those problems. I assume where the Fed puts interest rates or what happens in the bond market isn't going to impact the cash flows coming from a song that's 4 to 10 years
Correct.
old.
In my opinion, correct. I mean, and we really have been in this up into the right economy for quite a while. It's been a long run, and when that correction is coming, I think flocking toward these types of assets is a great place to go. But a really fun random aside, you mentioned AI. This is another reason I love music right now. Music is art. Art is such a human experience, person to person. People want to know the artist behind the song, how they made it, what was the story behind the lyrics. You connect with other people around the music. The artist is a huge part of the song. And,
Right.
that's something that can't be taken away from AI. Like, even with the creativity that AI's had around like literature, songwriting, like, people want to connect with who's creating art. And even with the rise of NFTs, remember the whole digital assets being created on computers instead of on paint and canvas. The NFTs that
Right.
took off because of the storytelling of who was behind it, who was the artist creating the digital art.
Think of like
Yeah,
Beeple. That was the classic case, right? It was like a real artist, a real person who had been making his art for a super long time, and the NFT was just a representation
ex
of that. It was like
exactly.
people love that story.
Exactly, and so perhaps there could be, artists and people who create art using AI, but people still wanna connect to that artist, and those rights are tied to a human that creates that art. To me, I think music is a great place to flock in the AI age of finding things that are AI proof to invest in, like, this is a space that I run to.
Yeah, I mean,
Artists
I don't know how AI is gonna go on the road and perform and give a live show with a killer guitar solo. I don't know how
it
that's gonna
just
happen.
can't happen. Just can't, and these older songs.
Show me the robot. I'll be
Yeah, I mean,
impressed. I mean, I'm
music
sure. I'm sure Elon's working on
Yeah,
one right
exactly,
now.
and music is the soundtrack to your life, certain songs remind you of certain
Yeah.
seasons, certain bands and artists are
Yeah.
certain seasons of your life that got you through hard times, and they help you
Yeah.
celebrate the amazing times, and those 4 to 10-year-old songs, 20-year-old song, you're not gonna stop listening to those because AI music is generated, like, that it has been created as a fabric, a part of your human experience, so I could talk about this for the whole podcast, but I will pause.
I mean, do you think consumer behavior changes in response to the economy with music? Like, is there more consumption, less money for the consumption that's happening, or is it just almost immune from cycles?
Well, I think the most important metric to look at there on the growth of music is really actually around streaming penetration by population. So, like, if you think
Wow.
about it, there's a huge cohort of like Americans who aren't on the streaming platform. So the older generations, like 50, 60, 70, 80, aren't using
Yeah.
those. And that segment of the population is adopting digital service providers at a very fast clip. So simply penetration into existing music
Wow.
listeners already will lift streaming. Goldman Sachs has a report out recently that everyone's citing about like the 8 to 9% average growth that is expected year over year through 2035. And it comes from that. It comes from an international adoption of digital service providers as well. So into countries that just have lower penetration and adoption. Um, so I think like the actual top line effect on music growth is much more driven by streaming penetration and less driven by like the blip in are the existing streaming people using the platforms more or less. I think that's just noise versus the actual part
I
of
mean,
the
that's
drive.
kind of incredible data because you think of streaming, a lot of us just take that for granted
Correct.
now. But that's very interesting to hear that the category is actually
Oh yes.
growing by by bringing on new
Correct.
cohorts. I mean, that's
Age
very
and
cool.
geography are driving that.
Um, but so when you do think about risk management, is risk management limited to sort of diversifying within the portfolio or across the portfolio with the right? I mean, how do you what does diversification look like?
Sure. Within music, if I were comprising a portfolio, I think of it as genre, right? Like country has had a huge
Okay.
revival in the last 2 or 3 years, which has been, interesting to see. Um, you know, and and you see other sectors that are having a dip. And so it's like, again, I'm not going to be a person who can predict whether Latin is going to have a rise versus rock versus rap. And so I say let's stay diversified across the genre. Furthermore, like just again by song count, like maybe there's an artist who experiences listenership loss for a number of reasons. Oddly and kind of sadly, even bad news, like negative news about an artist generally increases streaming revenue.
Wow.
So like if an artist goes to jail, that actually generally increases the revenue on that asset, which is a strange one to talk about, but it's so counterintuitive.
That is.
Uh, and so it's
Right.
sometimes hard to conceive of those instances that create listenership loss when things you would think would create that have actually in past proved to have the opposite effect. So, um, again, like diversifying in case there is some sector that falls out of favor for some reason is good. And then just as you do with any portfolio, it's like dollars into what deals, right? Like if you have a portfolio of stocks,
Yeah.
you're not putting 90% in one stock and then spreading the 10% out among 50 stocks. You're trying to be a bit more deliberate with that deal count and exposure size.
Yeah. So I think it sounds to me like you guys think a lot about portfolio construction
Absolutely.
and how to build a portfolio that you can count on to perform across over time.
And, something we didn't talk about is very nuanced. There are multiple types of or there are multiple types of royalty rights. You have streaming, you have performance, you have songwriting rights. And so diversifying across these different royalty types also has value. And so there are some
Oh, because I guess if you held performance rights during COVID, that would have been a
in,
problem because nobody was performing on the road
so
at least.
interestingly, yeah, yes and no. There that category actually encompasses other types of revenue that aren't that you wouldn't call, but
Ah,
yeah, so it's
okay.
a little more nuanced in the definition. But yeah, that could be part of it. And so
Got it.
yeah, like songwriting rights, for example, are fascinating intellectual property to research because songwriting rights are actually a set dollar rate that the songwriters are paid out per every play. Whereas the performance rights, which
Wow.
is the actual performance of the song and like the recorded the recorded version that gets sent out to the public, that performance royalties are actually like a formula based on how the song performs to other songs.
Okay.
So there's yeah, a lot of nuance in that, and being diversified across the rights types, I think, is important.
Do you guys have like an army of analysts? Like what's happening? Like there's
So, interesting. As we've built our business, there are multiple ways that we deal with like a deluge of deal flow. So, we actually have, yeah, two analysts who do intake underwriting where they, bring them in, review through an initial lens, and then there's some immediate obvious kickouts and whatever make it through that initial filter gets sent to the deal team, and they're actually, spending more time on the qualitative review and then stressing it further. But yeah, there's
it's a heavy
a whole
lift. It's a
process.
lot.
Yes. We burn our
Yeah,
calories for
very
the deals we
interesting.
do, that's for sure.
This is fascinating. So if we think about the specialty finance market and how it might evolve, uh, obviously you guys are working on more than just music. You guys are always looking for new opportunities. Uh, how do you see things evolving over the next 5 to 10 years in specialty finance? I mean, do you expect institutional demand to continue growing, and you think we're going to continue to have this kind of small deal space, that's growing and providing more opportunity, or do you see it stabilizing? What do you think? What do you expect in the
As
future?
long as banks are regulated, there will always be opportunity in specialty finance. I don't think the opportunity ever goes away, it simply changes. Banks are too slow to meet borrowers and customers, where they need to be. And so it takes banks a while to enter an asset class, get comfortable with it. And as long as there's that lag time, there's an opportunity for the specialty finance ecosystem to come in and serve kind of these parties. Music, as one example that we've been talking about, has become much more institutional. There are securitizations of music portfolios to date, rated securitizations, whereas 5 years ago, though that was like early innings of this asset class. And so, I think
Yes.
the opportunity for our firm and the way that, we view our evolution over the next 20 years is simply to stay at the forefront. Like where are these inefficient markets that need capital that will be responsible stewards of the capital? How can we do it kind of in these small deal sizes that just it's not efficient for others to do it? We'll go burn the calories, and we're a boutique firm. We can actually, do that profitably. And so just
Yeah.
overall in the ecosystem, as long as banks are regulated, the space is going to continue to grow.
I like the way you put that, in particular because I was struck when I moved into this realm. In our first category was, fix and flip loans, like you guys were doing at Patch. I really was blown away by the entrepreneurialism of the borrowers, the people who are putting the capital to work. And I feel like now that we're expanding into new use cases within real estate and new investments outside real estate, I'm seeing that same thing. I mean, the vibrancy of entrepreneurship in finding these categories and then needing financing in order to grow. I mean, I meet a lot of originators who are good in the 10 to $20 million range, but really struggle to imagine what it would be to get to 100 or 200 million. And we crossed that. I don't know, through luck or good fortune, or I think because we had a retail investor platform, right, integrated and on board that stood the test of time. But I think a lot of people struggle to get beyond that. And you mentioned securitizations because that's the brass ring that's waiting at the end, right? Like once you can get a category to where it's securitized, some people are like, "Oh no, that's gonna take away the opportunity for the retail investor," but far from it. It actually opens up more because you can participate in different parts of the capital stack, and there's more diversity, and it's better understood. It's a so I'm with you. I think I love the way you put it. As long as banks are regulated, entrepreneurs are going to need capital. They're going to need capital providers who can step into the breach and bring investors
Yes.
along. And I think there's unlimited opportunity. I
And
agree with you.
to be able to do it efficiently and fast, and, people will pay for speed, and banks, even
They
if the
will.
bank
Yep.
understands a segment, it doesn't mean they can move fast enough to serve that borrower in the way the borrower needs to be served. The institutional rigor that's required for an asset class to develop into a securitization asset, is amazing across the board for all investor types. Like that, it's well understood, it's audited. There's best practices that again are having to be used across the board for all originators feeding into these securitizations.
We were 10 years old before we did our first securitization. We've now done 3. Being SEC regulated was one bar we had to meet. And that was, generative for the company. And then meeting the bar for the securitization markets was a whole nother step, forward in terms of compliance, diligence, initial and ongoing. And, it's been great for the company to build muscle. We always said it would be institutional grade, product. We hoped that was true in the beginning. We worked our butts off to make it true. And it's nice that now the category and we as a company have met that bar. I think it's very, very interesting to see how these things evolve. All right. So let's wrap up with rapid fire Q&A. You ready?
Ooh, I am ready.
Let's do it. All right. Try to answer in one sentence if you want. If you want to expound. What's the most misunderstood concept in investing?
Liquidity. You undervalue it until you need it.
Oh, I'm bookmarking that one. Yep. One market signal you never ignore.
When capital is too plentiful. When there is too much capital, discipline starts disappearing. Too much capital chasing deals, like bing, bing, bing. Calm down, pause.
Got it. Biggest mistake you see investors making right now?
Relying too much on historical data.
Okay. A deal you passed on that you still think about?
Oh, lending against Rolex watches at scale. We didn't do it, and I still think about it.
And didn't Rolex watches like go through a huge spike in value, like around COVID or post-COVID?
Yeah, but the whole idea of
so no wonder you think
physical
about it.
collateral and
plus, if you foreclose on them, that's pretty
right?
cool.
New watch, hello, no.
Yeah. All right. And what's the most overhyped trend in finance?
Oh, calling every software business an AI company.
Boom. You said it. You heard it here. And if you weren't in finance, what do you think you'd be doing?
Oh, definitely full-time adventure blogger.
Adventure blogger.
Be like off.
Expound. What kind of
I'd
adventure?
climb mountains. I'd blog about it. I would go explore like fjords up in Norway. I would like go try interesting food in the rainforest, like Amazonian rainforest. Like I would just get into all pockets of the world and blog about it.
Look, when we started our companies 10, 12 years ago, I don't know if that was viable as a career, but I think it is now. All right. And lastly, if you could leave listeners with one lesson about investing in risk, what would it be?
Oh, this is so cliche, but it's so true. There is no bad deal, just a bad price.
Yep. I think that's a good one. I love that.
And it may be you have to pay me to take the deal. You might have to pay me.
Yeah, there it could be, right? You gotta, hey, that happened with oil. That happened with oil. It's hard to imagine now, but it happened with oil during COVID. People were paying people to take the oil because they had to store. They couldn't store it. All right, so we'll wrap things up now, Jillian. Thank you so much for taking time to join us. It was great having you on and sharing more about this asset class with music. Totally fascinating. The work you guys are doing is incredible. For our audience, if you'd like to learn more about Pier Asset Management, we'll include links in the show notes along with Jillian's LinkedIn profile, and you can check out all of our podcast episodes at groundfloor.com/podcast. Thanks for tuning in to Beyond the Stock Market.